Welcome to Real Estate Milestones, where we explore fascinating topics in commercial real estate with knowledgeable industry experts. I'm your host, Ben Malik, and I'm a young real estate professional who is passionate about adding value to people's lives through the incredible power of real estate. My goal is to help you discover what the heck is going on in the industry and how you can get involved. This is Real Estate Milestones, where your future in real estate lies just around the corner.
Hello, everyone. Welcome back to Real Estate Milestones. Today we have Jeffrey Donis on for the second time. We had, I guess it was about a year ago that you were on last time, but looking forward to catching up and getting an update on what you've been up to. So, Jeffrey, thanks for coming on.
Yeah, likewise, Ben. Appreciate you having me back on. Hope you've been well.
Yeah, been great. And same for you. So, last time we said we learned what your first milestone in real estate is. Now I want to hear what your what's your most recent milestone in real estate?
Yeah, so a few months ago, my brothers and we actually ended up closing on one of our latest acquisition in Atlanta, Georgia. It was a little under 200 units, C-class property, and it was a little bit of an older vintage deal, built in the 60s. So it did come with some deferred maintenance for sure, but that was the latest deal we did. It was a little under 20 million in regards to the purchase price, raised a little under 9.5 million, and currently now managing that property. Things are going well, but had a lot of learning lessons on that one. Still learning a lot about it, and it's given us a lot of confidence moving forward and as we pursue our next acquisition.
That's awesome. Congratulations.
Thank you.
It's a big deal. So yeah, good job with that. So I'm sure that there's a lot of lessons to come with that. So I guess can you tell us a little bit about how that went and what the lessons were before closing, and then you can get into more of the details after.
For sure. So for me in my role, I do the investor relations and capital raising part of it. So on that front, obviously there was a lot of pushback and just different types of obstacles we had to overcome. And the timing of this deal was, I would say, less than convenient, because as soon as we got it under LOI and under contract, that was around May and June, and the Fed started raising interest rates during that time period. So as that all happened, obviously a lot of investors and partners were scared. Even lenders were scared. They didn't really know what was happening. We didn't really either, right? No one did. So we were experiencing a lot of different obstacles, like lenders not wanting to lend on the deal, or investors not wanting to invest because they weren't sure where the economy was going. And if you were like watching the news or anything like that, you'd see everyone was saying, don't invest in real estate right now and just stay put. And for good reason. I mean, like, I can understand where they're coming from, but that's where, as an operator and as someone who's an active investor, you can educate your investors. So over time, we were able to get investors to feel comfortable with the deal and partners to feel comfortable with it. But it took a lot of phone calls, a lot of conversations, and also we heard a lot of no's from a lot of different people for the reasons I already mentioned mainly. But that was on the capital side of things. When it comes to the acquisition side, this deal, as I mentioned, was a C-class property, older vintage, and it was in a rougher part of Atlanta. So this obviously taught us a lot in regards to what people and our investors are looking for, and sort of solidified our criteria moving forward into the later half of 2022 and also this year 2023. So now we're looking at Class B 1980s vintage deals in areas that have 50,000 median household income or higher, and obviously little to no crime. And as I mentioned, Class B deals, and preferably Class B plus or Class A areas, because at the end of the day, you can like find a deal, but if you can't get the equity in place, then you're obviously not going to be in a good position. So it's good to keep that in mind before you're looking for deals and talking to brokers, so that you can have the criteria that if you find a deal that fits it, you can close.
Yeah, makes a lot of sense. I guess going into more of the details, I guess what was the biggest difficulty in terms of bringing everything together, in terms of like the thing that part of the deal, the part that you think wasn't interested, like the investors weren't interested in, or like the part that was yeah, like what was the difficulty there?
Yeah, so in this one, the median household income was lower than 50,000, $50,000, which isn't always a bad thing, right? We see deals that are in good areas, just perhaps the people there maybe don't make a lot of money, or in regards to other scenarios where There are just high crime in certain pockets that kind of will negatively impact the overall crime rate of the submarket that you're in. But when it comes to our property itself, we'll always look at each deal and make sure there's no crazy crime per or on site on the property, like a murder or things like that. But in this case, on this one, it was just not in the best part of Atlanta, and it is in the path of progression, and that's what we liked about it. Obviously, we're looking for value add opportunities. So with certain deals, these kinds of opportunities do come across where it's in a little rougher part of whatever submarket you're looking in, and that was our case. It was a little bit rougher, pretty low median household income, and then when it came to the vintage, it being a 60s build, a lot of lenders and investors get weary of it because the potential, you know, unexpected renovations that will come up after due diligence. And obviously, there's certain things that you just can't pick up on when you're walking the deal with a property manager. It's not like you can break down the walls and look at it, look at the entire property on the ins and out. But on this deal, that was obviously a risk with it being older, just increases the likelihood of there being an unforeseen expense, which is why now we've tweaked that criteria. But those are the main three issues I'd say was the obviously the higher crime that we like to see, the vintage, and then the median household income being lower than what most of our partners were looking for.
Yeah, that makes a lot of sense. And I guess like to your point, as you mentioned, that there's nothing inherently wrong with having a lower household income or having I guess, or if the area tends to have more crime. Yes, those are not great things, but
Yeah,
sometimes that the reason why I say there's nothing inherently wrong with that is because sometimes that means that you have the best deal, that other people won't want to go there, so that you
right.
can end up getting it for a lower price. It may be there's the most opportunity for improvement, right? You can implement security measures and fences and cameras and make it even safer. Therefore, the clients or the people tenants who are living there are safer there, maybe even willing to pay more rent. And also, a lot of times those opportunities are like the landlord may have neglected to upkeep that property, and maybe that's why you'd have such an opportunity to create so much value, because you can make the rooms better, the units better, make the hallways better, add amenities, make it safer, and all these things would lead to higher rents. I guess the issue is when those rents become too high, it'd be too high of a percentage of their income for it
Right.
to be tenable.
Exactly. And so to touch on the first point, I think where there's obviously things turning other people away, we saw it as an opportunity. So that's why we thought it was a good deal to pursue, and we did. And obviously ended up going well in the long run. Still not out of the deal yet, but obviously it's gone well up until this point. Now, to touch on your second point, when you mentioned in regards to I forget your second point. What was your second point?
That it's the opportunity to create a lot of value with in these properties, and that you can also, if you create too much value and try to boost rents too
Yeah,
high, it might be too
that
high
was
of a
it.
percentage of their income.
Yeah. So obviously you want to keep that into account, and what you're touching on is the way that our property managers are trained to run the numbers in regards to when they're screening their residents is, say the rent is $1,000 a month and an individual is making a certain amount. The way that we gauge whether or not they pass that portion of the screening is if you multiply that rent times 12, right, for 12 months in a year, then you multiply that by 3, that shouldn't be greater than their income for the year. So the median household income is just the average of the submarket that you're in. And for ours, as I mentioned, it was lower than what we'd like it to be. But what we look at is right outside of our immediate submarket, we saw there was a lot of different areas that were way more affluent than where our submarket was in regards to income. So when you look at that and you see where that progress is coming, we were not far at all from Midtown and downtown Atlanta. So obviously, with these areas increasing in regards to affordability is obviously getting harder, and there's a lot more demand for rental units in that market. We see that pressure coming into our submarket. So when you look at it from the grand scheme of things and overall in regards to that market, you'll see why there's still opportunity in certain areas, even though you might think of it as a little bit more risky, and perhaps it is. But I think that's where, as investors, you can get opportunity and, as you mentioned, win a deal at a better price.
Right. And to bring it even further, there's Atlanta is growing tremendously in terms of population and job growth, but specifically that there's a I know based on your deal, there were literal like new employment hubs like being built like
Yeah.
not too far, like very close by. There's like I guess the places that would create a lot of jobs. I guess in Atlanta specifically, there's Tyler Perry's film studio.
Yeah.
Aren't they expanding the airport? There's other
Yep.
things too, but
Amazon's
yeah,
moving in,
right.
Microsoft. I mean, like literally all these tech companies are moving into Midtown and downtown, and all of those are less than, 20, 30 minutes from our property. So when you see things like that, Atlanta's projected to be the number one market in 2023. Obviously, there's certain metrics that you want to meet when you have a criteria, but I also think you can't just copy and paste it for every single deal. There's certain opportunities that a lot of investors will overlook, but especially when you're getting started out, if you can just look at a certain opportunity and if you have a shot and then you can, if it makes sense, sometimes it just makes sense to take the risk and go for it, in my opinion.
Yeah, I mean that's I guess you touched on one of the things I find to be the beauty of real estate, that every single deal is inherently different than every other deal, right?
Yeah,
Like you cannot, even if you have the same exact building next door, that exact piece of land cannot be copied, right? It's the same,
exactly.
is the coordinates relative to the center of the earth, right? Like the longitude and latitude, like that's the only place where this property is. And that's something that's really interesting. It makes it unique. And that's why it takes critical thinking and other kinds of expertise to execute, because it's not like, every stock, every common stock from Apple, they're all the same, right? But not
Yeah.
every property is the same. So, speaking of difference in properties, you mentioned tweaking your criteria. I'd love to hear a little bit more about your thought process and what you're looking for.
Yeah. So after, as I mentioned, after doing this deal, we had spoken with a lot of different partners and obviously ourselves internally, and we just realized that right now, especially where we're going with the current environment in the economy and the capital markets, it makes sense for us to transition from being more of a C class type of operator into a more of a B class operator, where we're looking to increase in regards to or just change the vintage that we're looking at. So initially, as I mentioned, we were open to 60s build and 70s product, but now we're more so focused on a 1980s vintage, preferably early 2000s for various reasons. One, there's going to be less deferred maintenance. Two, residents tend to be a little bit less of a, put it into like, no, just a little easier to deal with. There's a lot less problems. Obviously, there may still be delinquency, but it's not as big of a problem as it is with other types of lower vintage properties, depending on the market. Now, obviously, it's going to depend on the submarket that you're in, but for the markets that we're in, that's what we're seeing. And then when it comes to actually getting deals done on the capital side, whether you're speaking about debt or equity, a lot of these lenders, when it comes to debt, are looking at properties that are in markets that have over 200,000 people, which is typically the top 20 MSAs in the country. That's where we're looking, and some of the biggest MSAs in the Southeast. And then when it comes to vintage, they're looking at the same vintage that we're looking at. The newer, the better for them. They see that as less risky. And then when it comes to purchase price and unit size for us, it's still 100 to 200 units. But as we were speaking about earlier, before we got on this call, the smaller the deal, the smaller the raise. And for us right now, with things being so shaky with interest rates going up, if we find a smaller deal that's under 100 units and it meets all of our criteria, like we're looking at one that has met all of our criteria, it's just outside of that 100 to 200 unit range on the lower side, we're not going to back away from it. And in fact, it excites me because I think it's a great way for us to do a deal during this uncertain time where a lot of people aren't doing any deals. And if you can get something done, obviously it being a smaller raise makes it more likely that you won't have as many issues. A lot of people were struggling to get their raises done during the last few months because of all the uncertainty. But the way that we see it is obviously right now interest rates are high and deals aren't cash flowing as much, but the interest rates won't stay up high forever. Eventually they will come down. And if you can get a deal right now at a discount, because a lot of sellers, most of them that need to sell or are selling, are doing it because they have to, not because they want to, right? Cap rates are expanding in certain markets, and whether it's by a lot or little, I still think we're getting discounts, and we're seeing that right now. So if we were to win a deal today and we could then refinance, let's say in 2, 3 years, we're not even projecting this, but it most likely will happen if interest rates come down. You'll be able to refi out of this high interest rate environment into something lower. You're going to have some type of equity there. So that's an opportunity if you can scoop something up right now. I think when people always talk about there being opportunities coming, I think they're starting now. I've seen so many different deals getting done, and personally with our acquisition process, we've seen a lot of deal flow and prices are coming down in a lot of the markets that we're looking in. So if we are able to find a deal that meets our criteria, we're not going to back down, but we do want to be extra conservative when it comes to the criteria that we're looking for.
Yeah, it makes a lot of sense. And I guess to take it even further, working in the, I guess even if you get deals below 100 units, that tends to even have less competition because
Yeah,
there's
right.
less of the institutional, like I guess less of the bigger operators, institutional. Like you're dealing more in the mom and pop space rather than the institutional and like really highly sophisticated space where I guess in that space, like cost of capital is really what drives the I guess cost of capital drives the acquisitions everywhere. But to I guess to take it even further, if you have these smaller deals, we know that you kind of get less of that economies of scale, right? The property management company might be more expensive relative to the
Yeah,
units, and there might be other things, considerations in that in terms of economies of scale. I guess how are you thinking about that situation from an operator's perspective? Given that if you are not managing it yourself, that would might be a even higher expense.
for sure. So when we look at it on this deal, as you already said, it's deal by deal basis. So in the other markets, it may not make sense to do this for us, but in the market that we're looking in with this deal that I'm talking about, I won't give too much details because we haven't won it yet, and I would hate to make my own competition. But in regards to this deal, it's next to a deal that we already own, not too far actually. It's maybe a half an hour, let's say. And when you're talking about it from the sense of one, our PM has already actually managed this property in the past, so they know the property. This deal is functions as a bigger deal, meaning it has its own leasing office. So a lot of deals that are smaller typically don't. This one has a pool, similar amenities, gym, playground, things like that. It's just smaller, and it in our underwriting we've already implemented having a full-time on-site property manager, and the numbers still pencil out. So when you look at it as at that, I don't see why you wouldn't go after a deal that big or that small, and especially for us, as I mentioned, one of the biggest reasons why we're going small is so that we can ensure that we don't have any issues on the raise and just get it completely finished. And when you look at a deal and you have partners who you're speaking with, and they can give you the confidence of saying, if you win this deal, we'll get this done. That for me, there's no reason not to go after it. If that makes sense. Which I touched on before the call. In regards to what we've been focused on is really strengthening our relationships, whether that's with our capital partners on the debt and equity side, but also just our other asset manager and things like that we work with, is to ensure that we're really brainstorming and talking preliminary on all deals that we're pursuing, so that when we do win it, we don't have any issues because we already all talked about exactly what would happen if this happens.
Yeah, it makes a lot of sense. It's touched on something you brought up also, that the fact that with these with I guess a deal of well, no, it doesn't really matter the size. I guess buying deals now, as you mentioned, cap rates have been expanding and prices have been coming down, and that I'm also under the impression that although interest rates are high, maybe not high historically, that is room for them to come down sometime in the future. And you mentioned that if they come down in the future, that would be an opportunity to refinance. I guess I want to hear what your thoughts on this are, but even if interest rates were to stabilize, I are were not to come down, I believe that in 2 to 3 years, refinancing would not be a huge issue, given that first, as interest rates stabilize, people are going to be less scared. All these
Right.
real estate businesses are going to have to start. So you're saying a lot of people are not buying deals right now, but eventually, if they're going to have to start buying deals, which would also put cap rates back up because you're going to get more competition per deal.
Yeah, down.
And then, or yeah, sorry, cap
Yeah,
rates are
yeah,
going to come back down, and because you're going to get more people bidding on those deals, right? But then
exactly.
also that you're going to have paid down some of your principal, which have built some equity in the deal, which can be used for the refinance. So I'm thinking like now, what I'm getting at is a lot of people are not doing deals now, but now might be the best time to do deals. I just want to hear
Yeah,
how you think about that.
yeah, that's exactly what like my mindset is, and the only thing is it's hard to find deals. That's why I know that's also why people aren't doing deals. I think a lot of people are on the sidelines because there's not as many motivated sellers right now as a lot of people are predicting there to be, because that's when a lot of these bridge loans from 3 years ago will start maturing. So therefore, there will be a lot of people that don't have a choice but to sell, and a lot of them, unfortunately, will be underwater or need to sell because they can't refinance, right? So they're now going to be considered motivated sellers. And when you're motivated, it leaves less negotiations on your side and as a seller, and puts it more on the side of the buyer. So that's where the buyers come in and now are able to negotiate lower prices. And that's why cap rates, people are predicting that they'll continue expanding. For us, we're looking, and this didn't make sense to me from the beginning. I hear people say, oh, I'm waiting. Like, I'm not going to buy anything right now. For me, I'm always looking. And if I can't find anything, then that's not a fun thing, right? But it doesn't mean I stop looking. And I know the deals will eventually come, but it's typically almost like always too late by the time that you start buying or start looking. And that means everyone's starting to look, which means it's just going to be more competitive and just as competitive as it's always been. So in my opinion, no one should ever stop looking. You should just, maybe you're not buying because nothing pencils out, you know? So that's how we've been approaching it. We've just been strengthening our relationships with the brokers, and that's how we found a few deals that we have some hope on, and we're pretty confident we'll win them, and at a really good cost basis because we were always in the market to buy.
Yeah, it makes a lot of sense. I guess something it's hard to predict or hard to I guess speculate on, and also maybe won't really give us much insight. But like what I've been thinking about is like, are more people on the sidelines because deals aren't penciling because interest rates are high and that prices haven't come down yet, and sellers haven't, or like sellers that are not motivated, or just people who might sell or want to sell or have not adjusted their expectations, or are people waiting for there to be motivated sellers and therefore thinking that it's going to come down lower, right? Like what I'm saying is that are people, I guess the idea is that are people waiting opportunistically for prices to come down lower, or people just, or sellers not adjusting their expectations yet, right? And it
I
seems
think
like
it's
kind of
both.
more, I want to
It has to be
hear what you
both,
think.
but it has to be both. But there are people that I've heard that have said they're waiting, and I'm sure you've heard that too. There's a lot of capital on the sidelines, is the saying.
Mhm.
Now, when it comes to like for us, when we look at deals, we don't look at it based on what we think will happen. We look at it what's happening right now, and obviously this I think everyone has their own investment philosophy, but it's all about cash flow for us. So when you look at a deal based on the current environment that and interest rates where they are right now, where does our deal pencil out? This is just a number. It's an analyzer that you plug information into. Now, obviously, you have more knowledge outside of the analyzer, like what the Fed's talking about and what the speculation is in the environment and the economy, and what do you think things will happen in the next 3 to 4 years. That will help you and maybe give you more insights as to how you should tweak your underwriting. But at the end of the day, it's whether or not this deal cash flows. And if it doesn't, if it cash flows right now, chances are the probability of interest rates coming down over the next 5 years, let's say, are pretty high, right? Because they're already really high. But I mean, if I had to put like a lot of money on it over 5 years, I would expect them to come down. I would put money against that. I say that's pretty high probability. Would you agree?
Yeah, I would agree. And I guess my fundamental thesis behind why I believe that is because the federal government does not want to service their debt at this rate. Like it
Yeah.
seems like they're paying us way too much money. I'm talking about short-term bonds and just bonds in general that if they could choose to borrow money at a lower rate, why would they do it higher? And I guess that's why inflation is the thing we're looking at, because if inflation comes down, then the spread between interest rates and inflation will also come down, and therefore they could move interest rates down even lower because inflation's down, right? So like that's kind of why I say if what they're doing is really to stop inflation,
Mhm.
that if inflation comes down, that would be that they would have a lot of motivation to bring interest rates down also.
Yeah, exactly. And if it cash flows, if your deal cash flows now in the current interest rate environment that we're in currently, and then interest rates come back down, cash flow would just go up if it's a bridge loan. And if it's locked
Yeah.
in, obviously you locked in something that you underwrote it at. So it's not like you're going to have any surprises. And then you can either sell and profit or refi, pay the prepayment penalty or whatever fees you have to pay, but you're still able to refinance into a even better interest rate environment. So if you think of it from the terms of as long as it cash flows today when I'm buying it, and then you can even in your underwriting, what you can do is have conservative quote unquote right underwriting where you're assuming it'll be worse in 3 years if you refi or worse when you sell. Whatever your exit strategy is, just assume it'll be worse. And I mean, if it pencils out with all of these things in place, you're just why would you not buy? Is my question.
Yeah, I'm under that impression as well, that if you do all of the sensitivity analysis and all of the stress tests on your deal, and that you're not underwater and you're not losing the deal,
Yeah,
that is, like that's the first question, right? is there a plausible scenario in which I could lose this deal? And if there is not, maybe there's just like the crazy, like outlandish, like, you couldn't predict scenario, but
Yeah.
realistically, that's going to affect people, or like it's going to affect people much worse if that's
Yeah.
the thing that breaks your deal, right? And so that if you can survive these I guess these stresses on in your conservative underwriting, that should definitely give you confidence in the deal, especially given that I mean, I don't know, like I guess the contra to that would be
Yeah.
that interest rates are still going up, even if they're going up slowly. What if the Fed just does 25 basis points for like a couple more months? Like it could get to a point where you have no cash flow. And I
Well,
guess, yeah, I guess,
yeah, I
you
mean, I think
know,
that all depends. You're right. Yeah, that most likely will happen. Let's say they do raise rates. Who knows? I'm not predicting that they're going to, but let's say they do. Either way, depends on what you're doing. And as an operator and as someone who is, your fiduciary responsibility is to protect your investors' capital. When you're going in, you're looking at that and you're taking that into account, whether you're going to lock in your rate or if you're going to go with bridge, you're either going to buy a rate cap. That's most likely what you should do, in my opinion. I mean, I don't know why you would go in. Now, there's an argument to make where people will say this is actually the best time to not lock in your rate, and it's the best time to get adjustable because based on historical figures and what the Fed has done in the past, this is the time when if you were to just keep it adjustable, it's more likely to come down in the next few years, meaning you'll actually end up saving more money versus locking in something at where we are right now with the interest rates. If you lock it in now, you're actually losing out on those savings that you could have had. So that's like an argument a lot of people are making. But either way, if you're going in, and as I mentioned, if you can cash flow today and you're conservative in your underwriting, assuming that it's going to be a higher interest rate on your exits, how could, I mean, chances are, now there's nothing that's guaranteed. This is an investment, right? But the probability of it being higher than where you are, and even if it is higher, how much higher? If it's a few, basis points higher, it'll still be like fine. Typically, interest rates don't affect, depending on how high you're underwriting it initially. If you're doing it right now, even if you do like 50 basis point higher on your when you refi or when you sell, regardless, it won't affect it as much, right? And it's more likely to be lower, is what I'm saying. So either way, I don't think the interest rates are really the reason. I think interest rates, what they're causing right now, more than anything, is sellers are not looking to sell because buyers like us are not able to pay the prices they're looking for. So they're waiting. But most buyers are actually not on the sidelines. I think a lot of people are looking for deals. They're just not able to make anything pencil out. And there's almost no deal flow right now. I know we were speaking about it earlier with brokerages, but most brokers right now are almost 50%, 40 to 50% lower in overall revenue this year so far than they were last year. So things like that are happening. It's real. And I think there will be more opportunities in the next later half of the year. But as a buyer, you should always be looking.
yeah, it makes a lot of sense. I guess in terms of that adjustable versus fixed rate debate, I guess that is a timeless debate. It hasn't been for many years, but I guess the idea is that if you have an adjustable rate and you have a rate cap and you still have cash flow after that, that you protect the downside scenario, but most likely, or rates will be stable or come down, and that will end up giving you more cash flow. That would be, that makes a lot of sense.
Yeah.
I guess that the idea is that if you don't have a rate cap, I'm just gonna give an example. I read this article. I think Veritas Capital, a big LA industry, or I guess multifamily,
Yeah.
but just large fund had to give back like a $400 million portfolio of multifamily because
What
they
about
literally bought bridge with no rate cap and interest rates went up too high. And I think they were literally handing in $400 million of multifamily. I haven't checked in the story recently, but that's just an example. Like, rate caps are definitely important if you're going to take the risk of an adjustable loan, which is, I guess, what people are learning in this last couple of years and starting now. But that I guess fixed rate in a way is if you can lock in fixed rate now with cash flow, like you're kind of set. That takes a lot of the
Right.
risk out of the deal.
For sure, for sure. And I think that's where you as an operator, an investor, you have to have an investment philosophy. And obviously the reason that a lot of people may not want to lock in a rate right now, as I mentioned, is because you're pretty much losing out on any potential savings if interest rates were to come down. Now, I guess this is where you as an investor need to sort of try to educate yourself on that topic so that you can have your own opinion on it, because people have different opinions on it, right? And then you can determine what the probability of interest rates being higher or lower when you plan on exiting, because that will dictate whether or not it makes sense to be, locked or not. But at the end of the day, if you choose to lock it in or not, either way, I think as long as it cash flows, as I mentioned, day one, that's where you can't really, my opinion, can't go wrong. If it cash flows today and you're locking it in, or you're not, and even if you stress test it and it still cash flows, obviously you can't stress test forever. So maybe I would personally feel more comfortable if I knew sort of what my downside risk was, and I didn't have it up to like, no adjustable rate, and who knows how high the Fed will go. So I think that's not necessarily a risk that we would be willing to take, but obviously there's an upside to it. So I think it just depends on the investor's philosophy.
Yeah, no, that makes a lot of sense, and that's definitely where it comes into. I guess maybe the last couple of years you didn't have to think as hard about these things, but now it's where it comes into that critical thinking and like figuring this stuff out and making your own kind of maybe predictions, but more like your own sensitive analysis of the likelihood of things going out and what that means for my business, for me, for you, and for any
Yeah.
individual. So yeah, I'm glad we had this conversation, got into the nuance of this. Is very interesting. I'm sure
Yeah,
everyone's gonna learn a lot. I guess you ready for lightning round?
for sure.
All right. So we did one last year. So I guess I gotta switch up the question. So let's start with
Yeah.
what's your favorite band or favorite
Mm.
musical act or artist? Just
Artist. Okay, cool.
yeah,
Um, yeah, I mean the first person that comes to mind, Justin Bieber.
nice. Why do you like Justin Bieber?
I think like recently he's like some good Christian songs. I like him. He's like I'm not a lover boy, but he's got some like it's a mixture of pop and good hits, and it's wholesome music in comparison to like the old music I used to listen to, like rap and stuff. Not very wholesome.
Hey, there's some wholesome rap. I love
Oh, for
J.
sure.
Cole.
I said not the ones I was listening to.
Ah, I got you. J.
Yeah,
Cole. He's my favorite. He's my favorite
he's from Fayetteville, actually,
rapper.
North Carolina.
Yeah, yeah, true.
That's where I
That's
live.
it's in
But,
your neighborhood.
yeah.
Definitely. But so what's I guess we know the last book you recommended, if I remember correctly, was Think Like a Monk. I read that. I loved it.
Yeah.
Definitely cool to get that Western angle on
Yeah.
a very Eastern philosophy, which is really cool. That was a really, really interesting way of integrating in a lot of like tangible, actionable lessons of Buddhist thought.
Yeah.
What's another book that you love? I'm gonna read it because you got a good recommendation last time.
Yeah, man, I'm on a roll. Have you read Shoe Dog?
No, but I downloaded Goodreads yesterday and I put it on my list already.
Yeah, you should read it. You'd like it. I love it, honestly. It was really good.
Awesome. I'm gonna put it. Yeah, I'm gonna move it up to the top of the list.
Yeah, man.
But yeah, I see some of the books you got behind you. You have Who Not How, Rich Dad Poor Dad. Okay,
Think and Grow Rich.
Think and Go Rich. Creature from Jekyll Island, Principles. All good books. Creature from Jekyll Island is the one that screwed with my mind the most.
Have you read that? Okay, that's long.
Yeah, it's a long book, but it's pretty crazy. um, very relevant to the conversation today, though. So,
Yeah, I know.
I guess this advice may have changed from last time, but what's a piece of advice you give to someone who wants to follow in your footsteps?
Yeah, I would say for me it's two things. One, like I guess they kind of goes hand in hand. So at the end of the day, I think we're all defined by what we spend our time on, whether you're in prayer with your faith or reading a book, trying to learn something, or spending it with certain people. It all comes hand in hand. So the books you're reading, the content you're listening to, what you're thinking about, all these things will make out what your life and external looks like. For me, my number one advice is spending your time doing the things and with the people that you'd like to be like, or that will make you better in whatever way that means to you. For me, it's faith, obviously real estate, education, family, things like that. But I try to spend my time with the people that will make me better and improve. And it comes down to trying to be a multifamily syndicator, spending time with multifamily syndicators. So sometimes that does take an investment, or just reading their books, listening to their podcast, creating a podcast like you did, Ben. I think it's awesome because you're able to get us on and all these people and peers and network, and now that your peers onto a call with you for an hour, right? And it's an invaluable amount of time for us because we get to network, you and me. So I think people may make excuses for not having enough money or not being smart enough, whatever. Like at the end of the day, it's just if you invest that time into it, you can literally do anything, in my opinion, most things, right?
Hmm. Definitely. Well, that's I definitely feel that, and definitely part of the motivation for starting a podcast. Definitely spend a lot of my time listening to them too. But it feels like if you're not directly talking to them, like I've become friends with so many people who don't even know who I am. Like Lex Friedman, I consider him a good friend, even though he's never heard
Yeah,
me speak. I listen to him for hours, probably thousands of hours.
yeah,
But yeah, you get to you. It's really like spending time with these people because you get to hear their thoughts and their feelings and their knowledge, and you get to learn from it and grow from it, and get that influence, and their hard work, their mindset rubs off on you, and it's like spending time with people, with friends.
100%.
So and since I put you on the spot, I want to give you another chance for revenge. So what's another question you have for me?
Yeah, man. What's the hardest thing that you had to do this week?
Oh, that's a good question. The week started, today's Monday.
Yeah, man.
um
What's the hardest thing? No. Let's go back to last Monday.
Last Monday, well, I was gonna say, I guess one thing came
Gotta
to
go
my
with that
mind. I read Dante's Inferno. I read it yesterday, and that was just like really intense book. It's about, like just these incredible depictions of people being tortured in hell. And it's pretty scary. And so that was pretty hard. It was also like hard to. It's like, it was written in Italian and translated to like Old English, so
Yeah.
kind of like really like trying to soak in what was being written about and why it was important. I guess that on that same note, I was reading Aristotle's Ethics, and like that's hard to read, but like, you can just read it, but like the hard part is like actually engaging with it and like reading it, like what does he really mean? Like
Yeah.
that's a mental exercise. Like you can't do that without enough sleep. Like you have to,
Right.
it takes like an hour to get through a couple pages. You really got to like push yourself and like understand what it means, and then convert what it means into what does that mean for me and how can I become better. And like that's a hard exercise. Anyone who doesn't think it's hard is not getting
That's so
out
true.
of it what they need to be.
That's so true. That's something I struggle with. I read like the Bible, for example, half the time I'm like, I do not know what I just read, but I did my 10 minutes, you know what I mean? So that's something that I
Mhm.
could do better is like you said, engaging with it. I think that's important. That's
Yeah,
awesome.
speaking of, I'm in a class called it's pretty much Bible and philosophy. And so I'm reading Genesis, but like I'm
Cool.
spending like probably a week per page, and
Really?
really, really thinking about it. And there's like the layers never stop unraveling. The amount of wisdom baked into the Bible is
Yeah.
just incredible. So
Man, a week.
yeah.
That's insane, bro.
Yeah,
That's
well,
so
I have to write. It's also part of my homework. I have to write like 8 pages on like one
okay.
passage of Genesis. Like I'm reading. I've only gotten like I'm only on book three. I've read the creation and
Yeah.
the garden so far.
Cool, man. Yeah. I don't yeah, I've been reading it for like a few months now. And I mean, I do 10 minutes a day and I'm not going that fast, but I'm thinking I'll read it again one day, but it's so long. You know, I feel like it'll take me 2 years to finish it. I guess you just keep going. I don't know. I guess I'm figuring it all out.
Yeah. Well, I'll send you my essay.
Yeah.
You'll go back and like I didn't even like But some people just read the Bible. Some people like really, really deeply go
For
into
sure.
it. So
Yeah, man,
yeah.
for
You get a lot from both ways. Either you get to learn how to
sure.
live, or if you just look really, really hard, read really hard, you learn why you ought to live in a certain way. So,
100%.
um, awesome. Well, that's a cool way to end it. Where
Yeah.
can people find out more about you nowadays?
Yeah, so my brother made an awesome checklist for anyone who's looking to vet a passive investment opportunity. It's www.donisinvestmentgroup.com/checklist. You can visit that same website minus the /checklist to visit our website. And then we're on all social media platforms at Donis Brothers. I'm at Jeffrey Donis. And then also make sure to check out our podcast, The Real Estate Monopoly.
Yeah, REM. That's a good
Yes,
naming
sir.
convention. Well, I encourage everyone to check out what Donis have to offer. A lot of Donis brothers have to offer a lot of good stuff, and excited to stay in touch and see your progress. Exciting. Love to learn
Yeah,
alongside you, and till next time.
awesome. I appreciate it, Ben. God bless, bro.
Awesome. Jeffrey and everyone, keep making milestones.
Before you go, I just wanted to say thanks again for tuning in to another awesome episode of Real Estate Milestones. If you've been enjoying the show and you'd like to offer your support, please leave a 5-star rating and review on Apple Podcasts. It's the best way to increase the show's visibility and help the message get out to a greater audience. I really appreciate your time and support, and keep making milestones.
The information provided on this podcast is intended to be educational and informational only and is not considered to be formal legal advice. The listener should not take or refrain from taking action based on its content. Any listener in need of legal opinion upon which to rely in decision-making should consider formally engaging an attorney to review relevant facts in detail and examine the pertinent law as it applies to those facts.